Hello and welcome to the Morningstar series, Why Should I Invest With You? I'm Emma Wall and I'm joined today by Nick Hayes, manager of the AXA Global Strategic Bond Fund. Hi, Nick.
Good morning.
Strategic and global, which means you can look pretty much anywhere and everywhere for growth for investors, which is just as well at the moment because the world is not giving you very many options. Perhaps we'll start with the markets where rates are rising and how that impacts your portfolio. US probably going to go around June, July again is what most people think. And then the UK probably not until next year now. But both of those a rising interest rate environment.
Yeah, absolutely. There is clearly issues around the outright level of government bond yields at the moment. They are very low on a historic basis. They don't look great value compared with equity yields or even credit yields. But we still think there's a place for government bond yields. If you look at this year, for example, the number of interest rates priced into the market 6 months ago was way more than we got now, and suddenly the returns on government bond yields have been quite attractive because, again, 2016, like so many years before, you've priced in lots of interest rate rises, but actually you've got much less. And I think that's kind of the world we live in now for the next few years. Expectations might get ahead of themselves, but they'll probably be dragged back, and actually I think there's a place for government bonds despite being quite expensive in the portfolio.
I suppose one place that you wouldn't be one to buy state-issued bonds would be Europe and indeed Japan, where we're moving into negative rates and perhaps even further negative. How do you invest in those markets, or do you just say, actually, I don't want any geographical allocation to that region?
With very, very little geography, it's very difficult to justify why you would have, German bonds that yield 15, 20 basis points for 10 years. So it's difficult to make an argument there. That being said, just under a year ago, we probably invested in long-dated German bonds. They're probably up 20 points in that period. That's a huge return for something that started yield was relatively low. So we're starting to rotate out of government bonds in Europe, avoiding negative yielding assets. But there's two options. You either go into credit or you go into long-dated or even core sort of US fixed income. We're buying long-dated treasuries as a bit of a hedge against also buying lots of credit and high yield, which I think is much more attractive.
And within that corporate sector, those business-issued debt, are there any sectors that are looking particularly attractive, or is it very much an issuer-by-issuer case?
It's a bit of both. You've had big issues in the last 12 months around the commodity-related sectors. So the US high-yield market had a difficult 2015 as businesses and investors started to reprice people's expectations for where oil and other commodities would be. Expectations got way too bearish, so people started talking about $10, $20 a barrel. Needless to say, as ever, the market got too bearish and things sold off too much. 2016 has been a great year so far for US high yield. So we've made good money out of core US high yield, but also some of the commodity-related names. So some of the energy sector, some of the sort of oil and gas names have done really very well. As again, people's expectations for oil got too low. It's now coming back up, and it's now maybe people are thinking $40, $50 a barrel rather than that very bearish $10 or $20 a barrel.
You've alluded to quite a lot of uncertainty in the market. How does that affect duration? Do you think actually I'll hedge my bets and go for long because who knows what's going to happen, or indeed the opposite?
We've actually been doing exactly the former at the moment as a bit of a hedge, not because they're cheap assets, but we've been buying long-dated treasuries, partly because we think investors, again, will be buying longer-dated assets as the short-dated stuff is such a low yield, but also in terms of portfolio construction. If you buy long-dated treasuries, for me, that means it allows you the risk budget to go and buy high yield, go and buy emerging markets. So I think as a portfolio construction tool, I think long-dated treasury is not always the most popular, but I think it's quite an interesting asset class.
Diversification and risk management.
Absolutely.
Nick, thank you very much.
Thank you.
This is Emma Wall for Morningstar. Thank you for watching.